Hello, all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on our credit quality assessment for H1 FY26. India Inc. holds firm. Can it navigate global turbulence ahead? We sincerely appreciate your joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Gopal Mahadevan, Director Strategic Finance and M&A at Ashok Leyland Limited. Mr. Manoj Tulsian, Joint MD and CEO at Greenply Industries Limited. Mr. Nikhil Sohoni, Group CFO at Blue Star Limited. And Mr. Rakesh Kaul, Executive Director and Chief Executive Officer at Clicks Capital Services Private Limited. This session will be moderated by Mr. Sachin Gupta, Executive Director and Chief Rating Officer at CareEdge Ratings. We will commence the session with the presentation by Ms. Smrita Rajpurkar, Senior Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in their panel. We will take up your queries at the end of the discussion. Now, may I invite Smita to make the presentation.
Thanks, Mamta. Good afternoon, everyone, and a warm welcome to CareEdge Ratings webinar on credit quality assessment for the half year ended September 2025. In our webinar, we will take you through our assessment of the credit quality of CareEdge Ratings rated portfolio in H1 of FY26 in the backdrop of the prevailing global and domestic economic environment. We'll first take you through the key highlights of our presentation. The global economic environment has remained uncertain with trade tensions and tariffs, but the domestic economy has exhibited strong demand with support from GST rate cuts and other policy measures. In this backdrop, CareEdge Ratings Credit Ratio, that is, the ratio of upgrades to downgrades, has strengthened to 2.56 in H1 FY26 from 2.35 in H2 FY25, which is the earlier half year. If you look at the sectoral cuts, credit ratio of the manufacturing sector moderated to 1.72 in H1 FY26 from 2.06 in the earlier half year. The moderation was mainly due to low upgrades in some of the sectors like capital goods, healthcare, and auto components. Against this, the infra sector credit ratio surged to 8.54 in H1 FY26, a significant rise from 3.94 in H2 FY25, driven by better performance in the roads and power sectors. Also, BFSI sector credit ratio improved to 2.10 in H1 FY26 from 1.07 in H2 FY25. Indian corporates have thus stood strong amid the global headwinds. Let us now briefly go through the economic landscape. Global growth is expected to slow down to 3.0% in calendar year 2025 from 3.3% in calendar year 2024, which is well below the pre-pandemic average of 3.7%. This may be attributed to uncertainties in the global environment with tariffs, increasing costs, and persistent geopolitical tensions. With the US imposing tariffs on its trading partners, the average effective tariff rate has increased to 18.6% as of August 25, which is the highest since the 1930s, with India facing the highest level tariffs. The US 10-year Treasury yield also remained elevated at over 4% amid fiscal concerns and tariff-related inflation risks. Further, China's long-term growth outlook still remains feeble with a subdued property market and fixed asset investments, along with the US tariffs remaining unmonitorable. The global scene thus continues to be hazy with ongoing geopolitical tensions, global tariff war, and growth concerns in China. Amid this, the domestic economy still remains resilient. In FY26, India's GDP is projected at approximately 6.5%, considering that we get a relief from the additional 25% tariff. If the 50% US tariffs continue, it may shave off around 0.8 to 1% of our annual growth. While direct exposure is moderate at approximately 2% of GDP, the implications in the form of competitiveness and trade disruption may be serious. Consumption is expected to boost with policy measures like the recent GST cuts and income tax relief measures, easing inflation and good monsoons. We estimate GST rationalization to lower CPI inflation by 70 to 90 bps annually under the current CPI basket, and the lower GST rates will cushion the impact of an anticipated increase in CPI next fiscal year because of the lower base. We estimate GST rate changes to trim center and state revenues by approximately 0.2% of GDP each on an annual basis, and the FY26 fiscal impact is pegged at around 0.1% of GDP for both center and states. After the cumulative rate reductions of 100 bips by RBI since February 25, we were not expecting any further rate cuts, and RBI has stuck to the neutral stance even in the recent policy announced. We are also not expecting any rate cuts this year, but there may be a possibility of a rate cut in December if the high tariffs persist. Let us have a look at some domestic economic indicators now. If we see the trend of the GDP growth over the last few quarters, we see an uptick in the latest 2 quarters, signaling recovery. The pickup in the private final consumption expenditure, that is 7% in Q1 FY26 versus 6% in Q4 FY25, was supported by the rationalization of income tax slabs, easing food inflation, a favorable monsoon, and recent RBI rate cuts. Gross fixed capital formation growth moderated but remained healthy in Q1 FY26. Recovery of consumption is crucial for meaningful revival of the private capex. We'll now take you through the high frequency indicators. GST collections and e-way bills generation remain at healthy levels, and both manufacturing and services PMIs have been improving consistently in the recent months, staying firmly in the expansion zone. Here, the left chart shows credit growth moderating across sectors, while in the right chart, we can see the CD ratio remaining under the 80% threshold. RBI's recent reforms to stimulate credit growth may provide the much needed fillip, though. India's current account deficit, that is CAD, moved to a deficit of USD 2.4 billion in Q1 FY26, which is 0.2% of GDP, as against a surplus of USD 13.5 billion in the previous quarter. The full year CAD is thus pegged at 0.9% of GDP, which is still at comfortable levels. FX reserves are also healthy at approximately USD 700 billion. Thus, healthy FX reserves and comfortable current account deficits should cushion against external shocks. While services exports are expected to remain healthy, good exports could feel the pressure. The goods exports could feel the pressure from the ongoing tariff war. Tariff-related uncertainty and developments around the US-India trade deal will be crucial to monitor going forward. Let us now look at the impact of the US tariffs on the export-focused sectors. India is largely a domestic-driven economy, with exports to US being at just 2%, limiting the overall impact of the US tariffs on our economy. This chart shows the impact of the US tariffs on vulnerable sectors, with the total exports by value on the x-axis and the sectoral impact depicted with color coding. As we can see in the chart, two major constituents of merchandise exports, that is electronics, predominantly smartphones, and generic pharma, being currently out of the ambit of US tariffs, are not expected to be impacted. While the US very recently imposed 100% tariffs on patented pharmaceuticals, India is the major supplier of low-cost generics to the US, and hence CareEdge believes that the impact on Indian pharma players will be minimal. However, some of the other export-focused sectors like gems and jewelry, essentially cut and polished diamonds, textiles, and marine products are expected to be highly impacted. Cut and polished diamonds, that is CPD exports to the US, form nearly 35 to 40% of the total gems and jewelry exports from India, and jewelry being a discretionary item, the CPD exports may decline by up to 20% in FY26. This is in the backdrop of competition from lab-grown diamonds and weak Chinese demand. Talking about textiles, US comprised around 30% of India's total textile exports, with home textiles and ready-made garments forming its major share. The relatively high tariffs on India vis-a-vis other major textile exporting countries to the US like China, Vietnam, Bangladesh, Pakistan and Turkey has placed us at a competitively disadvantageous position, thereby likely to impact demand and profitability of the sector. Overall, textile exports could fall by around 10% in calendar year 26 on a YOY basis. In marine products, shrimps constituted around 75% of overall marine exports from India, with US having almost 50% share in our overall shrimp exports. We are thus at a significant disadvantage vis-a-vis other key shrimp exporters like Ecuador, Vietnam, and Indonesia, potentially impacting export demand by up to 15% in calendar year 26. Other sectors like leather products, automobiles, and components and chemicals are moderately impacted. Apart from the direct impact on sectors, there is also a second order impact possible, like reorganization of supply chains, job losses, and reshaping of trade relationships. On the tariff front, thus, it is a wait and watch situation currently, and the Indian manufacturers are hoping that they get some respite from the additional tariffs. In this backdrop, let us now understand how the performance of our rated portfolio has been in the first half of FY26. In this chart, we can see CareEdge Ratings half-yearly credit ratio trend. Credit ratio is the ratio of upgrades to downgrades, in the portfolio reviewed during the particular half year. We can see in the chart that the credit ratio has been on an upswing in the last 3 half years. It rose from 2.35 in H2 FY25 to 2.56 in H1 FY26. Overall, there were 282 upgrades and 110 downgrades in the first half. With upgrades more than double the downgrades, it clearly indicates that India Inc. has remained firm against the global odds. We will now take you through a deep analysis of the portfolio performance. Here we have tried to juxtapose our credit ratio trend over the GDP growth rates, and we largely see the credit ratio mirror the GDP growth, indicating that the performance of our rated portfolio has been in line with the economic trends. This chart shows us the trends in the credit ratio of our investment grade and below investment grade or sub-investment grade entities. The investment grade entities are entities enjoying ratings of BBB minus and above. The credit ratio for the investment grade portfolio continued its upward trend, rising from 2.70 in H2 FY25 to 2.83 in H1 FY26. Meanwhile, the below investment grade portfolio showed steep improvement, increasing from 1.75 in H2 FY25 to 1.97 in H1 FY26, indicating sustained strengthening across both segments. The resilience in the portfolio is thus witnessed across segments. In this chart, we can see rating actions across rating categories. Notably, higher rating categories experienced higher proportion of upgrades, showing resilience. As we can see, the AA category saw 17% upgrades with no downgrades, and the balance 83% being reaffirmations. Similarly, 23% of the ratings in A category were upgraded in H1 FY26. The chart to the right shows the rating category-wise distribution of upgrades and downgrades. So, we can see that a large portion of upgrades were from higher investment grades of AA and A categories, that is 15% and 35% respectively. However, a portion of these upgrades can also be attributed to group companies upgraded on change in sponsor profile or enhancement in the structured payment mechanisms. Downgrades from these categories were significantly lower at only 1% of the downgrades being from AA category and 22% of the downgrades coming from A category. These two rating categories exhibiting strong resilience also form a large chunk of our portfolio at around 40%. We thus see these higher rating categories exhibiting stronger buoyancy. This slide shows us the percentage of upgrades and downgrades to the total rating actions over the years. In this chart, we can see that upgrades inched up further to 15% in H1 FY26 from 14% in H2 FY25, while downgrades remained stable at 6%. The steady momentum in upgrades alongside high reaffirmations underscores the resilience and stability of corporate credit profiles. Overall, the portfolio has remained stable post the pandemic, with 80% of the ratings being reaffirmed in the last 3 years. We thus saw the performance of CareEdge Ratings portfolio across various cuts. We will now move to the sectoral trends in the credit ratio, but before that, we'll quickly look at some aggregate financial indicators. Here we have presented the aggregate trend of key financial indicators of around 6,700 entities, excluding the BFSI entities, over the past decade. We can see that the interest cover has moved up from 4 times in 2016 to 7 times in 2025, and the leverage, that is total debt by EBITDA, has improved steadily from 3 times in 2016 to 1.63 times in 2025, demonstrating the cautious approach of the Indian corporates and thus the leaner balance sheets. The profitability metric has also shown an improving trend from 10% in 2016 to around 14% in 2025, thus indicating a healthy overall financial performance. Moving on to the sectoral trends now. The manufacturing and services sector credit ratio moderated from 2.06 in H2 FY25 to 1.72, but still remained strong in H1 FY26, driven by sectors including hospitality, mid-sized entities in capital goods, real estate, iron and steel, healthcare, and agricultural food products. The credit ratio for infrastructure sector jumped to 8.54 times in H1 FY26, driven by significantly higher number of upgrades in the transport infra and power sectors. The credit ratio for the BFSI sector improved to 2.10 times in H1 FY26 from 1.07 in H2 FY25. This was mainly driven by upgrades in banks and housing finance companies. Let us now deep dive into the reasons for rating actions in these individual sectors, our outlook, and some key monitorables on the credit side. Let us start with the manufacturing services sector. Manufacturing services sector accounts for a substantial share of our rated entities, contributing roughly around 65% of rating actions in H1 FY26. As we can see in the chart, credit ratio of the manufacturing services sector during H1 FY26 continued to remain healthy at 1.72, primarily driven by upgrades in domestic focused mid and small sized companies. The large corporate entities rated in the high investment grade also continued to exhibit steady performance. As we can see in the chart below, upgrades have outpaced downgrades over the last 2 years in the manufacturing sector. Let us now look at the individual subsectors contributing to the strong performance. Key sectors driving upgrades during H1 FY26 were hospitality, mid-sized entities in capital goods, real estate, and iron and steel. Upgrade momentum also continued in pharmaceuticals and healthcare. On the other hand, sectors that witnessed more downgrades were chemicals, especially entities in basic petrochemical space, primarily due to a pricing pressure arising from intense Chinese competition. This apart, small-sized auto ancillaries or dealers, textiles, and trading and distribution entities also contributed to rating downgrades. As we can see, the sectors driven domestically have stayed strong, while the export-oriented sectors, that is textiles and chemicals, have seen downgrades. To talk about the outlook for the sector, we expect the overall credit quality to remain stable on the back of sustained domestic demand for manufacturing as well as services sectors. Domestic consumption demand will boost considering the steps taken in the past few months, like the recent GST rationalization and income tax rates and lower interest rates. However, merchandise exports are likely to be adversely affected if the US tariffs persist at 50%, keeping the demand and profitability of key US focused sectors under pressure. Nevertheless, corporate India's deleveraged balance sheets in general can provide some cushion. Let us now move to infrastructure. The credit ratio for infrastructure has been on an upswing, rising sharply to 8.54 in H1 FY26 from 3.94 in H2 FY25, with more than a quarter of the portfolio witnessing upgrades in this half year. The robust performance of the portfolio is anchored by upgrades in transport infrastructure and renewables. We can see in the chart that transport infrastructure and power, especially renewables, saw significant upgrades, taking the overall credit ratio for the sector to its all-time high. Upgrades were largely driven by commissioning of projects, especially in the road hybrid annuity model segment and solar power generation space, and timely payments from most of the state distribution utilities, resulting in faster than expected deleveraging for power producers and transmission infrastructure providers. Apart from the sector specific factors driving upgrades, a major contributing factor for the performance in this half year is the very construct of the sector, with project assets operating under special purpose vehicles, that is SPVs. In H1 FY26, multiple portfolio assets were upgraded on change in ownership to strong sponsors or transfer to InvITs, enhancing the financial flexibility of the assets. Downgrades were due to delays in receipt of requisite approvals, slow project execution, weak order books, increasing working capital pressure for some of the mid-sized DPC players, and moderation in financial flexibility of specific project assets of weak sponsors. Overall, the outlook for the sector remains stable, with enhanced revenue visibility anchored by government's infra push. Renewable tariffs are expected to remain competitive vis-a-vis conventional power, aided by decline in module prices. Diversified EPC players are expected to benefit from increased focus on transmission, urban infrastructure, water, and roads. We'll now move on to the BFSI sector. Credit ratio for the BFSI sector improved to 2.10 in H1 FY26, reversing the drop reported in H2 FY25. Upgrades were mainly driven by improvement in the financial risk profile of banks and housing finance companies, and upgrades in few groups having multiple entities in other financial services like broking, or wealth management. Downgrades, on the other hand, were driven by deteriorating asset quality and weak profitability of small finance banks, that is SFBs and NBFCs operating in microfinance and unsecured business loan segments. Deeper into the microfinance sector, we can see in the chart that credit costs for the sector jumped to 9% of average total assets in FY25 compared to 2.6% in FY24 and are expected to reduce in FY26 but would still remain elevated, impacting profitability. With this, the return on average total assets slipped into negative in FY25 and is expected to be in the same territory in FY26 as well. While we are expecting a rebound from H2 FY26, the overall picture for the microfinance sector remains bleak in FY26. Nonetheless, the secured asset classes like home loans, loan against property, etc., have held strong, and our outlook on the NBFCs remains stable as the larger entities are well capitalized, which drives the sectoral averages. Coming to banks, upgrades in the banking sector were mainly on account of improvement in asset quality, capitalization, and profitability. Net NPA ratio for the banking sector is at its lowest ever level of 0.5% at the end of Q1 FY26, down from 0.6% at the end of Q1 FY25, due to continued improvement in asset quality and high provisioning coverage maintained by banks. This is likely to form the bottom base. Our overall outlook on the BFSI sector remains stable. Banking tech sector credit profiles are expected to benefit from robust capitalization levels and stable asset quality. Advances growth is expected to remain subdued in the current fiscal, with moderate economic growth impacted by increase in tariffs, competition in the wholesale segment, and cautiousness in certain retail segments, especially unsecured products. However, the recent reforms announced by RBI are expected to enhance accessibility of credit, encouraging borrowings and foster growth. Names of the banks are expected to moderate due to pass on of rate cuts, while impact of deposit rate reduction remains to be seen. Similarly, the outlook is expected to be stable for NBFCs in secured asset classes such as mortgages, while the MFI and unsecured loan segments are still under pressure. With this, we come to the end of our presentation and we will sum up our observations. The manufacturing and services sector remains upbeat with stable credit profiles aided by strong domestic demand and policy measures. Export heavy sectors, however, may face margin pressures in the near term, even as leaner balance sheets act as a cushion. However, if tariffs persist, the second order effects such as weakening competitiveness, diversion of capital from export linked industries, and slow investment flows could weigh on the credit quality. Infrastructure entities have exhibited a strong performance backed by improved project execution and financial flexibility. We see them buoyant going forward as well, being domestically driven and anchored by the strong government push. Banks and NBFCs are also expected to remain stable with robust capitalization and asset quality of the secured portfolio. Stress, however, still persists in some pockets like the MFIs and the unsecured loan segment. Overall, corporate India has weathered the storm so far. The question now is how well it can navigate the global pressures. If the external uncertainties persist, it may temper the credit quality outlook and lead to moderation in the credit ratio in the near term. With this, we come to the end of our presentation. Thank you so much. We will be releasing a detailed report capturing this presentation along with a deep dive view of the various subsectors as well after the webinar. We will now hear from our eminent guest speakers and understand their views. Handing over to Mamta.
Thank you, Smita. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Sachin to take over the session, please? Mr. Sachin Gupta serves as the Executive Director and Chief Rating Officer at CareEdge Ratings, the second largest rating agency of India. With over 24 years of experience in leadership positions across the credit rating business, Mr. Gupta brings with him in-depth knowledge of credit ratings across sectors including infrastructure, financial services, and corporate sector. Prior to joining Care Ratings, he worked as a senior director at CRISIL and managed the corporate and infrastructure ratings. He holds a bachelor's degree in civil engineering from Delhi College of Engineering and an MBA in finance from the Faculty of Management Studies, New Delhi. Over to you, Sachin.
Thanks, Mamta. Thanks a lot. And thanks, Smita, for a quite a comprehensive. I know it's very difficult to cover the whole corporate world in 20 minutes. I think you did your best. Great. So I'll start with a quick introduction. We have a very esteemed panel that we have today across diverse industries. First of all, Mr. Manoj Tulsian, he's the joint MD and CEO of Greenply Industries. Prior to joining Greenply, he was the CFO at JMC Projects, VIP Industries, and Gabriel India. He has rich experience in the field of finance, taxation, M&A, and he's a qualified chartered accountant and company secretary. I'll come to Mr. Gopal Mahadevan. He is Director Strategic Finance and M&A at Ashok Leyland. Mr. Gopal joined Ashok Leyland in July 2013 as CFO and has been central to the turnaround and growth of the company. He's also a member of the board of several subsidiaries of Ashok Leyland Limited. Before this, he was the CFO at Thermax and Amar Raja Batteries, where he also played diverse roles in Sanmar Group. He's a CA and CS with over 35 years experience, and he has several accolades to his credit, including those of the best CFO by CNBC TV 18 in 2012 and in 2011 by the Institute of Chartered Accountants of India. We come to Mr. Nikhil Soni. He is the Group CFO at Blue Star Limited. Prior to joining Blue Star, Mr. Soni was Senior Vice President at M&M, Mahindra and Mahindra Limited, where he worked for over 28 years. Mr. Soni is an executive management alumni of IMD Business School, Yale School of Management, and Harvard Business School. And finally, we have with us Mr. Rakesh Kaul, Executive Director and CEO at Clicks Capital Services Private Limited. Mr. Kaul has been leading Clicks Capital as Executive Director and CEO since August 2021, and he's currently serving on the board of Clicks Capital, Clicks Housing Finance, and Tesseract Fintech. He joined Clicks from RHB Malaysia, where he led their retail banking division across Malaysia and ASEAN markets. And prior to RHB, Rakesh was with Citigroup, where he spent over 2 decades across retail banking, corporate banking, and small business banking divisions. A very warm welcome to all our panelists. Thanks a lot for taking time out and participating with us for this discussion. It's very interesting times, and I was just kind of thinking about our overall corporate world. And if I really take a 20,000 feet view, I see that our inflation is manageable, our interest rates are quite benign. The GDP growth rate in the first quarter is also very good. The corporate leverage, as we just saw, is quite low, at the lowest level in the last 10 years. The overall BFSI, the banking sector, which have faced its own challenges in the past, is also good. So if you look at the big macro, it seems pretty good. But still, and you saw the commentary, we still are a little worried. While the past seems very good, the concern seems to be more on the future as to how it will be, and especially with these tariffs which have come about. The government has taken a lot of actions, but it's the impact could be potentially serious. So anyway, I'll ask my first question to Mr. Gopal Mahadevan from Ashok Leyland, sir. CV sector per se, is generally seen as a leading indicator of the GDP growth, and it's a closely monitored parameter. And we have had now this GST rate cut, and which is very recent. How do you see the impact of this GST rate cut, and also in addition, good monsoon, playing out on the CV demand over the next 1 or 2 years?
Thank you for this, and I think it's a very interesting. I must compliment the presentation that was made, and thank you for the opportunity. I think the CV sector is very positively impacted, and I'll go beyond the rate cut itself. But the rate cut is absolutely positive. There is nothing negative at all about the rate cut, and this will hopefully induce certain amount of buy. But this is a B2B business, so pure rate cuts will not be the only decision why somebody will buy a truck. Whereas it could induce cars. But having said that, this industry has been kind of making this request to the finance ministry, and they have considered that. And so in that sense, I would say this is a very big positive. But having said that, what is happening now with data and information that is available, we are actually seeing that people are using tools to drive asset productivity, which is again good, because once you see productivity of assets coming in, the ROI improves and there is further investment coming in. Because all said and done, we are a supply chain deprived, distribution deprived economy, and the cost of supply chain, as pundits would say, is about 13%, 14% of GDP, and we want to bring it down. That means we need more and more, productive assets, be it trucks or any other form of assets, to ensure that the supply chain happens. And very quickly, finally, what is happening is we believe that at this moment we are on the cusp of a replacement demand, because there has been a huge change in technology on trucks or buses for that matter. We were BS1, BS2, BS3, BS4. Then we took a huge leap to BS6. We were the only country to do that in April 2020. And now you have a whole conglomerate of vehicles running, and this will stop at some point in time. And you would actually see that, the later technology vehicles would multiply over the next 2 to 3 years. And we are actually seeing that demand will start growing up. And finally, this big sinusoidal waves of huge demand and huge glut, what I call as the periods of feasting and fasting, I think they are over, because people are not going to buy trucks and pray for loads to come. They know exactly how the economy is running. They have as much information about the various sectors. So the investment that is made is very prudent. So to that extent, if you look at all of this, right, all of these kind of augur very, very well for the commercial vehicle industry.
Got it. Got it. Great, great. Thanks. I'd like to get in Mr. Soni from Blue Star. Your company is actually a very good mix of both B2C sales and B2B sales, right? How do you see the GST rate cuts impacting the demand or rather driving the demand?
Yeah. So, thank you for having me here. On GST rate cut, it is impacting in a large way to B2C, that is room air conditioning. That is where, of course, B2B is also marginally impacted, but more it is for B2C in room air conditioners. Now, over there, if you have to ask me how it will impact, let me tell you, this is a very unique year, particularly for air conditioning and consumer durables. I think it's very unique for air conditioners in the sense that it is on the back of exceptional demand last year. So last year we had a growth in the industry which was almost at 40% up, and this was a year which was following that. So there was a huge expectation, and in light of that, people had even stocked up. But then we had a very wet summer. The rains this year have been kind of started early and have been still continuing, which means the Q1 was virtually a washout when you compare to last quarter one. And then you have a Q2 which you were looking forward to, which got severely impacted because of the GST announcement which came in, because everyone kind of postponed their sales, saying that let the new rates come out. So you have two bad quarters on which you are sitting. So if you I have to answer your question, I'll put it in two buckets. Whether there will be a short-term spike, there will be some, of course, because last 1 month, of course, there has been no sale, so there is no reason why there should not be one. Having said that, the range still continue. So which is a dampener, and AC is a product where it's still considered as a luxury, which means a person will only go out and buy that product when he really needs to. So the summer is compelling. The October heat again may become compelling, which then forces him to go out and buy. And that's how, it's a very uniquely placed. With rains, he's still holding on, I will say. So we have not seen the expected spike which was there. Probably it was expected to be much more, but then there is still a lot to come. The way I will say is that there are two types of demand over here. One is where a first time buyer will go out and buy. The first time buyer who will go out and buy is definitely going to be enthused with this GST cut reduction, as it's going to kind of be a little more affordable for him. And there are a lot of people who sit on the fence. So that's going to be a structural shift. And this won't remain a short term. It will become a slightly elongated long term shift, because these guys will always find this now 4,000 rupees cheaper than what it was. Having said that, there will be a replacement demand, or there will be a demand in the city urban sides, which is people who kind of are going to replace their ACs, where they may there will be a pull forward effect, where it could be a short-term impact, and later on the kind of volumes can kind of taper off. So we will have to look at the kind of customer that is going to go out and buy there, and that's going to impact it. Second, there are other enablers like consumer finance, okay, which also is very critical. Affordability, disposable income. That with this tax announcements last year in the budget, it has gone up. So there are good enablers which are there. Consumer finance is coming up very strongly, and today is a substantial portion of the sales. So all of this augurs well for the industry, and this is a very low penetrated industry. The penetration level is as low as 8%. While you have other kind of electronics items like TV, refrigerators, which are well above 50%, which means there is a good runway which is there. And hence there is no reason why GST should not be a great enabler, and should help push up the volumes over here.
Got it. Got it. I think you said it very well. So while we may not have seen much action yet, it's a little too early, and maybe October heat will help your revenues grow further. You talked about consumer finance, and on that count, I will get Rakesh from Clicks Capital. And so while overall, as we saw in the presentation, also the corporate, India Inc. and all that, we are seeing clearly strong credit performance. But if there is one or two pockets where we see there is a bit of stress, that is on the unsecured loans, and that's been continuing for last 3-4 quarters. we keep hearing that it is improving and the stress will be over in maybe this quarter or next. Rakesh, what is your sense? Is the stress now over? Are you seeing improving collections, especially on the unsecured part of the business?
Thank you, Sachin. Thank you very much, and thank you for a very comprehensive presentation. So maybe I'll divide my response in two bits. What led to this over exuberance in lending post COVID is that all balance sheets in lenders had been recapitalized, and there was huge pent up demand. So the first couple of years post COVID led to people borrowing a lot more than they could afford because incomes really didn't grow in the same tandem. And what we saw maybe about 12, 15 months ago was the peak of that over leverage. Inflation was still very high and sticky. Interest rates were still very high. And we saw that RBI had already started to raise a lot of warning signals about unsecured lending going out of control, and brought in very strict fintech lending rules as well as raised weights on unsecured lending. That triggered what I call as a healthy deleveraging of these loans, and we started to see the segments who had over leveraged starting to face some defaults. I think while inflation has thankfully cooled off, rate cuts have been announced but not yet fully transmitted. We do feel that we are not going to declare this as the end of the problem, especially in the microfinance segment. We believe that very early green shoots have started to emerge where deterioration of collection efficiency has probably ebbed. But recovery is still about 2 to 3 quarters away, provided these metrics continue to show improvement. How lenders have responded to this is that, of course, new underwriting, they have been much more cautious. And that's why you saw that MFI loans have shrunk 39% year on year. And as have the microfinance, the micro small business loans, they've also shrunk about 32%. And lenders have obviously augmented collections capacity. So while on the older portfolio, we will start to see improvement in the next 2 to 3 quarters, the good news is that the new underwriting is already very conservative. And hence, over the next 2 to 3 quarters, both will converge and we will hopefully start to see some improvement. And by that time, the benefits of GST cuts, the benefits of lower income tax, the benefits of inflation staying low will all kick in, and hopefully we will come back to the expected credit behavior. The good news is that this is not a systemic issue. It is very, very specific to three segments: MFI, small ticket personal loans, and small ticket unsecured business loans. So very early days, but I will not call it a full recovery, and we will have to wait for 2 to 3 quarters, Sachin, to see how it pans out.
Got it, Rakesh. I think you've said it well. We still need to be kind of monitoring it very closely, and we also have a large portfolio of entities in this space, and we continue to do that. I'll get Mr. Manoj Tulsian, from Greenply Industries. One of the slides that we saw in the presentation was the overall deleveraging of the corporate India, right? And that is where we see that over the last 10 years, any parameter that you look at, interest coverage or debt to EBITDA, we are pretty much half of leverage what we were then. Now, and that is the question is, while the good side is as a rating agency, we like that. But as an economy, that also means that there is not enough capex which is happening by the corporate world. So, Mr. Tulsian, with your experience across multiple companies and industries, what is your sense? Are we going to see a trigger of high private capex in the near future, especially with this GST rate cut and other incentives which the government has been giving?
Hi, Sachin, and thank you for getting me on the forum. I think it's a very interesting question. So everything, including the presentation, what we have seen, and whatever the other, even the panelists, what they speak about, everywhere you will see positivity in what we are talking about, except that one issue where we are not able to see the level of growth, maybe. Right. So, and like you also summed it up very well in terms, whether you see interest rates, whether you see inflation, whether you see growth, whether you see the BFSI sector, how they are doing, or the infrastructure, they're all looking good, in piecemeal. But somewhere, I think it's a very pertinent question. What you're raising is, on the private capex side, maybe a few things which, if I have to dwell upon, one, if you really see, there's a lot of uncertainty, which is still there in the environment for some reason or the other. Sometimes it's a geopolitical tension, sometimes it's the tariff war. See, the quality of the balance sheets have improved, no doubt about it, right? When I talk to a few banking people, I also find that there is still a very cautious approach now, which has prevailed in the banking sector. So companies which don't need money, there they are willing to extend a lot of more money, right? So like today, fortunately, in my organization, even if I'm not needing that much of capital, every bank is coming and asking me that, why don't you take more capital? Okay. So possibly the banking sector has become very cautious. And so is also the entrepreneurs. Because the way the reforms have taken place in the last 5-6 years, when you look at the insolvency process and everything, even the corporates are now very cautious and slightly, I would say, fearful also in terms of deleveraging. I mean, leveraging their balance sheet. So, but this is something which possibly the banking sector has to go first and make those changes. Because if they are not going to change their cautious approach, you will not see money going as growth capital. They're willing to lend to people who actually don't need that capital at that point of time, right? So the numbers may look good, but actually it will not result into capex. That is one. Second, if you look at again the parameters, I think the infrastructure is now doing well. When I look at your presentation, when I hear from even my earlier colleagues and everybody, so there is a lot of government spending which is happening. BFSI looks to be very good. Other than some of our panel members, what they have brought about special highlights on some of the issues. So I think money is there in the system. Okay. The three important things which, if it does well, you will see always things will kickstart: real estate, infrastructure, automotives. Infrastructure, government spending has gone up again, right? Automotives, I think big push after this GST cut. I was just reading the newspaper today, more than 1 lakh vehicle got registered in this last few days itself, which is, I think, one of the best numbers ever. And the third is real estate. Real estate, in bits and pieces, we are seeing some quarters going here and some quarters going there. So once these three areas starts doing well, okay, it will lead to a cascading effect on the consumption on every damn thing. I look at a few other data points where I see that, in the industry level, when you talk about the manufacturing side, I'm still saying the capacity utilization is somewhere around 70-75%, because it has not really picked up in the last 12 to 15 months. The moment it starts crossing 80-85%, that is the time when the corporates also starts deciding about new capex. And I think one more factor, which is like today, businesses which are dependent on a lot of exports, or even if they are dependent on a lot of imports for their production, are businesses which are very cautious because of the tariff war. Every day you are coming to know something new. A lot of challenges on the shipping side because of this geopolitical tension. So maybe people, and as Indians, we are very cautious always. So like, one of the panel member, what he said, the pent-up demand. After COVID, actually, if you really see, the propensity to save had gone up significantly. People had nowhere to spend money for a good 1.5 years, right? People were employed, but they were not even spending maybe 2% of their salaries, right? Except maybe the daily needs. There was no other expenditure. So when things opened up, there was a pent-up demand, and everybody started believing that it's better to spend money rather than to keep it in the bank account. So we saw that pent-up demand, and we are only talking about that. We are only believing, why not we go back to that level of growth again? We are growing well. It's not that we are not growing well. When you look at the global growth versus our 2 times today, it's a very healthy growth. And with the type of reforms which has happened in the country, I mean, I don't see any reason that, we are the superpower and we will become the superpower for the next 2 decades.
Okay.
So
On that
I
note,
don't
I
see
think,
any reason at all.
yeah. So I think on that note,
look at my company.
let me hold you.
Add
I'll come
to
back
this,
to you.
Sachin.
I'll come back
just
to
add
you.
one more line. Wait. I'll just tell you one more thing on this, which is very important. Like we are manufacturers of goods, which is all consumed in India. So we have not been scared of investing money into the business. We have invested quite a bit of money in the last 4 years, done a capex of more than 1,000 crores. The business has been 3 times in the last 5 years, 3x. Okay, so a domestic consumption story is something which is very, very strong. So if you are relying on domestic consumption story, I
Mr.
think
Tulsi,
the capex
I have a counter to that, and I will get Mr. Mahadevan there. We have all, including the entrepreneurs and the government, become so much inward focused with some kind of a protection which is available, that we are actually scared of going out and really competing with the Chinese and other people. And really, and Mr. Mahadevan, since you run a large CV company, and that is one of the areas that which could be a potential exporting opportunity for India. And we are seeing Maruti and Hyundai, they kind of playing a big role in CV, not CV, but passenger car exports. How do you see India's capability, especially in the context that China is kind of really becoming into its own in a big way? How do you see India will be able to compete in the global arena in manufacturing high-end products like yourselves?
Is this question addressed to me? I dropped off
Yes,
a
sir.
bit.
Yes, sir. Yes, sir. Yes, sir. Yeah, yeah.
Yeah. You see, I think there are 2, 3 things. One is that, and this is not to complain, but if you look at the perspective, right, India had moved from an agrarian economy directly into a services economy. So the manufacturing sector, the capabilities had not been steadfastly kind of nurtured. And I'm not complaining. This is how it has happened. Right now, we are seeing that that manufacturing is the base which creates the employment and creates the thing, because the ratio of agriculture and the employment has become very, very lopsided. Very small portion to the GDP, very large portion of the employment, and it's becoming unproductive. Having said that, I think we would, while I'm not going to talk about protectionism and all that. I think the government has done a few right steps in the past few years to nurture manufacturing, and the whole China plus one strategy that has also evolved with specific focus on Indian capabilities and manufacturing is actually good for the country. But we still have some bit of distance to go. And we need to get technology kind of independence. And there again, I believe that while private capital can keep investing, there is a certain amount of government impetus that would help in this journey, because we need to become technologically self-reliant, and that's not going to be a 1 or 2 year journey. But having said that, we are seeing 2, 3 things happening in India. We are seeing that, at least from my perspective, if you look at it, the capabilities of the vehicles that we are producing is by far the best in the addressed market that we have in comparison to East Asian markets. The Western markets are completely different in terms of the price points, the deliverables of the vehicle. So to answer your question specifically, I think almost all sectors, and some of my colleagues had kind of also shared the same perspective. I think the capabilities in Indian manufacturing are quickly rising, and we should be in a position to adopt technology, but leverage it to kind of ensure that we are actually taking it to the next level. And we continue to invest. So both private capex and government, at least on infrastructure and support for technology, will certainly help. Net, I would say that if you look at traditionally commercial vehicles specifically, you would see that almost all the players in all economies are local players. The top 3 or top 2 of them will be local players, whether it is in Europe, whether it is in America, whether it is China, whether it is in any other parts of the country. Some amount of challenges will always continue as imports, but I think that the domestic manufacturing is very fast catching up.
Got it. Got it. Thank you. And let me get in Mr. Soni, who also is, kind of at Blue Star is again focused on manufacturing. And there also we have seen that there've been government's PLI scheme and the whole Atmanirbhar kind of a campaign running through. But we still see that even in air conditioners, which is kind of a huge domestic demand, I think we are still dependent for some of the components like compressors, etc., on China. So, do you not feel that? I mean, I'm not talking about Blue Star in particular, but in general about the industry, that we should be more self-reliant on a basic component like compressors. And do you think something is holding us back in that sense, considering that we have a huge domestic demand to fulfill?
Yeah. So Sachin, let me just take a step back and say before coming to components, look at the finished goods itself. Okay, if you have to look at 15 years ago, the entire thing was imported. The entire finished goods used to be imported and sold. So it was a pure trading models that people used to operate. Okay, subsequently it slowly moved to where part of the production became in-house production. And today we take pride that at least the AC, as far as the manufacturing goes, now it's manufactured entirely into India. So that's the transition that the finished goods side has taken up. A lot of that also supported by PLI. So as we are aware, that plus component, almost more than 6,300 crores of PLI for AC industry itself was there, and that is what is supporting that. Having said that, coming to component, let me tell you, yes, there is a lot of dependence, but again, one has to look at it in this manner. 4 years ago, 70% of the components were imported. Today, if you look at it, around 30 to 35% of the components are imported. So it's a journey. It's not going to happen overnight. People are investing, going from trading to manufacturing, changes the entire business model, changes the balance sheet, and people are kind of accordingly moving towards that. Component wise, if you ask, there is a dual challenge in when you look at things like compressors, electronics. It's not only and more in compressors. It's not only the availability, it's not only the cost, but it's also the technology. So all of these are a challenge right now, and that is the reason why you are seeing the BIS norms which are there. They are also being relaxed on an annual basis by the government. That is because the readiness is still not there for entirely making it in-house. Having said that, you will see that even a lot of foreign suppliers also have started investing in India for components. So you have NIDEC, GMCC, all of them investing, Magmit, all of them have started investing into India. And not only are they investing into India, but if you look at their component supplies, 50% of that is now localized. Okay, even if you look at the PCBA, that is printed circuit boards and assembly which happens, almost 30 to 35% of that is now localized. So you are seeing a good amount of localization which is happening, and that is on the back of a good kind of PLI support, as well as the fact that there is a clear push for Make in India, which is critical at this stage. So I don't think that the movement is not towards that. I understand that yes, compressors are still imported, but just the earlier answer I gave you, it's a very price sensitive industry, and a huge level of penetration is waiting to happen because of the pricing. As of now, China can give you at a cheaper cost. As we manufacture, as we start kind of moving towards that, as the PLI support comes, yes, we will be able to be more competitive. I think you will have to balance it out so that you have the growth in the industry. At the same time, you have the domestic manufacturing starts happening. So the direction is very clear there.
Got it, Nikhil. And I think the one sentence that you said, that it's a journey, and we are increasingly becoming more and more self-dependent. I think that is the kind of journey we will have to continue. Okay, I let me get Rakesh back. Rakesh, RBI guidelines, or this a couple of days back that they came, while there was not any tinkering with the interest rates. But I think there were a lot of reforms which kind of have come out, and which clearly, and even a couple of other decisions which RBI has been kind of announcing in the last 6 months or so, clearly indicates their comfort with the growth. And you mentioned in your previous response that the RBI was kind of holding back excess growth in especially unsecured or NBFC kind of sectors, or even for banks. How do you see now the growth for the NBFC? And for the moment, let's park out the sector within, say, MFI, others which are facing challenge. So it's not easy. You don't want to grow when there are high delinquencies, because you may build a wrong book, and because you want to deleverage that segment. But otherwise, apart from that, the typical secured lending that you have, how are you seeing the growth kind of coming through over the next 1 or 2 years? Are we gonna come back to that 30% kind of a 30-40% growth that we saw 2-3 years back post COVID, or it's gonna be more stable, more kind of sedate?
No, so I think all the measures announced by the government and RBI in the recent past are all very positive for credit growth to come back. I think lenders have again, with every cycle, they keep learning new lessons. I think this last 12 to 15 months of experience of credit costs and unsecured, especially, has again been a era of learning. with the advent of new technologies, and especially the way lenders are now adopting AI as a core strategy for their future, I believe that growth will come back. It may not go back to the post-COVID exuberance that we saw, but returning back to high teens for the industry and specifically for NBFCs, which are more nimble in their approach and always chase segments faster as compared to the banks, we believe that NBFCs will come back to the 20% plus growth. I mean, if you see some, while unsecured became a bit of a pain, but if you look at other secured lending, especially gold loans, which became like a proxy to giving credit faster to a very large segment of the economy. I think it's seen massive growth in the last 4 to 6 quarters, and with thankfully the gold prices staying firm, we believe that this asset class will continue to grow. And with more money in hands of consumers and companies because of both the income tax and GST reforms, we believe passenger segment, commercial vehicles, and finally the consumption loans, will all see much better days ahead. I'm very confident that the industry is going to see very good growth rates in the next 1 to 2 years, Sachin.
Thanks. I think interesting point you made on the gold. I think all the while Indians were kind of blamed for importing so much of gold, and the current account deficit used to be a cause ki why are we importing? Everyone has got this fetish with gold, but now finally you can monetize in a big way,
Yes,
and
very,
which
very
is what
big
you're
way.
saying. The high prices will allow them to borrow more and then spend on their basic needs. Okay, let me take the last question with Mr. Manoj Tulsian, and then we will open the floor. And basically, I wanted to understand from you in terms of threat of Chinese imports, which is basically what, when we say global headwinds and all that, essentially it's the Chinese because which we are generally worried about. So in your segments or even otherwise other industry components, are you seeing, because there is a bit of, BIS protection, there is a bit of tariff protection the government has been doing. Do you foresee some change, in the government's philosophy in terms of protecting the Indian domestic industry? And secondly, despite that protection, do you see the Chinese could be again, kind of eating? Because we've seen that in sectors like, especially chemicals, that has been very badly affected despite some kind of a protection, but they are really facing severe challenges. So, Manoj, what is your sense on the segments that you are looking closely?
So I think, to start with on my own business, when I look at it, I think this, the BIS implementation is making a huge difference. Of course, it's more of commodity, so it's not like we were importing too much of plywood or MDF directly from China, but there were many other countries from where the material was coming to India. But they were like chalk and cheese. They were not equivalent to what we were making in India. They were mainly coming to India on price advantage, and the quality of the product was not similar to what we were manufacturing. And since there were no guiding force, so it was easy even for the OEM. And when I'm saying OEM, I'm saying furniture manufacturer. I mean OEM in that sense, were able to use it because they were only looking at price point. Now all these furniture manufacturers are now turning up to us, but they still don't want to move away from the price points at which they were getting the imported material. Now they are chalk and cheese. So I think the BIS standards is going to make a lot of difference. Okay. And the reforms, what the government is taking for sure is in that direction. Like Make in India furniture, when we are talking about, clearly we are talking about that the furniture has to stand to the level of international quality. That is the reason that, we are not a net exporter of furniture. Correct. So I think when I look at the sectors, I see the government is very clear in their thought process. But such a nothing happens over 1 or 2 years. It takes 5 years, 10 years for a reform to really work. I think directionally we are very, very sound. But when you go to China, I mean, I keep visiting China, the scale at which they operate, I mean, for us to reach to those scale, one, we need a lot of capital investments. And we come back to the same cycle, now that maybe the government has taken some measures on GST correction, right? This will, in a way, propel consumption. The consumption will need will eat away the capacities, and then you will have capex. You'll also get the confidence over a period of time. The balance sheets are improving. So the private sector would tend to invest more money into CapEx. But the scale at which China is today versus what we are is like maybe 5 or 10%. When you look at go and see their size, they are huge. Yeah. So it will take time, but I'm sure that the government is very much into it, and we are in the right direction. And that's why I'm like personally, as I said, I'm very gung-ho that next 20 years, if not more, belongs to our country. This is the place to be.
Yeah, great. Thanks, Manoj. Mamta, can we open the floor for questions from the audience?
Sure, sir. Attendees are requested to please key in your questions for the panel for the question and answer session.
While the questions are being, collated, Mr. Mahadevan, I have one question for you. In terms of we're seeing a lot of this electrification trend that is there in on the passenger cars, and it kind of is a full, and then Europe is kind of taking lead, and then Chinese cars are kind of becoming very, very popular in India as well. How do you see the electrification of this whole commercial vehicles? Do you think there is a business case, and is it like sometime in near future?
It's a very good question. Actually, it has already started. The electrification in buses has been significantly stepped up because the government has, taken steps in the PM E-Drive Yojana scheme. There is also this, there is a nodal agency that has been done, CESL, Convergence Electric, that is actually doing the orders for this. See, what is happening is these buses actually are at the moment, I would say, used in cities because the pollution levels are brought down very significantly. Customer ride comfort is actually significantly improved. Cost does not change, and this has been a very compelling proposition. Now, what has happened is something that has happened innovative to the industry, and what we are also doing in Ashok Leyland is we have a subsidiary called as OHM. Now, OHM actually owns these assets and does an operating lease for 12 years with these STUs, because what is happening is at the entry point, electric bus would be roughly about at the moment 5 times, maybe 4.5 times that of or maybe about 3 times now. It is, as we speak, the prices are coming down. It's about 3 times that of a normal bus. So to ensure that the adoption rates are getting better, we have actually entered into pay per kilometer, and that is what a lot of STUs are doing. So it's becoming a very interesting model, right? And this is becoming like an annuity for asset investment. And on a total cost of ownership, the best part of it is battery prices have come off so sharply from $250 per kilowatt hour to something like about $100 per kilowatt hour.
Correct.
The cash payback or the convergence between diesel and EV is somewhere in the 4th, 5th year. So
of
we are seeing
the
a lot
capital
more
cost.
adoption.
You recover your high capital cost through low
You're saying
operating
the convergence of operations, capital cost plus the total cost of operations of a diesel vis-a-vis that of an electric vehicle, electric bus. So what is the same thing is happening in scooters and two-wheelers also. What is happening is the capital cost may be slightly higher, but the operating cost so fast quickly catches up that the user is able to benefit from it. Trucks are getting evolved and they are getting into closed loop operations. We ourselves are, selling trucks for mining applications, for cement, steel plants, where you have a closed loop where you go from the plant to the distributor. I think only yesterday, the government has again announced a complete 100% subsidy on charging infrastructure. So we are actually going to see a lot of play. One of the best things which we don't know is that the Indian government has been having EV adoption and alternate fuel, not just EV, it is hydrogen fuel cell, etc., are actually on the country's agenda, on the government's agenda to ensure that adoption becomes faster. This is not the case with the Western counterparts, mind you. So I believe that I'm pretty bullish about the EV adoption that's going to happen over the next 2 to 3 years. You're going to see a marked change.
And including the heavy commercial vehicles, you mentioned about the buses and this will also
certainly, yes. Heavy commercial vehicles will also see a change because finally, what the proposal is, you pay a slightly, if you take out the capital cost or take out the battery, and if you put the battery and the electric cost and defrag it over the operating life of the asset, actually that is lower than the fuel cost. the conventional fuel cost. That is how we'll have to see the whole proposal. That is why battery rentals are coming in, swappable batteries are coming in, because there's a whole convergence of technologies that have started to come in. So you're getting battery swapping. Now you've got EV charging facility. Now they are looking at how to monetize the EV charging facility 24 hours a day, because the actual usage is maybe about 18%. So if more and more cars coming in, if more and more maybe even motorcycles come in, then how can these same EV charging facilities actually help? And finally, I think just like in the mobile where you are now standardized into USB-C globally, the day is not very, very, very far off when you're going to see standardization of the chargers themselves.
Charging infrastructure. Yeah, got it. Thank you. So we have a few questions that I can see here. First question, Rakesh, it's for you. They are saying, do we envisage any further support from the regulator on troubled NBFC segments, mainly MFI and small ticket business, both personal and commercial? It is from Neeraj Kulkarni. Any further support from the regulator on troubled NBFC segments?
I mean, not that, Sachin, we have heard of any such scheme being thought about. There was some talk about, a way to try and support with a better CGTMSE coverage. I think that is the one area where the government has really announced a lot more investment this year. So the guarantee scheme in which portfolios can be now insured with CGTMSE is becoming a very, very strong way to protect credit costs for the future. But will there be like an OTR scheme or something like that, which the government had done during COVID? No, we are not hearing about any such thing like that. And companies are having to clean up their balance sheets on their own. We've not heard of anything, or neither have we heard of any discussion item in any of the forums where there is a plan to approach the government to support some troubled NBFCs.
Got it. And I think the situation has not been worsening. While it is serious, but it is not worsening to become systemic and all that. So I think RBI is closely monitoring.
Yes.
But they would not really, I mean, normally they also don't spend money. They kind of want you to stand on your own feet.
Yes.
So,
yes.
Got
Absolutely.
it.
Absolutely.
Yeah. Next question. We have actually these two questions are actually, maybe I can take them. One is, what impact we see on manufacturing sector in medium term if additional 25% tariff is not withdrawn by US? Now, that's a very good question. Honestly, in the sectors that we spoke of, the ones which were marked red, which is basically marine products, gems and jewelry, and
textiles.
I think there it will be very difficult. With 50% tariff, the point to be noted is how is our relative position? We are at 50%. Most of our competitors are between 20 to 25%. And it's a very competitive world. And we don't have such economies of scale to really eat or manage this 25% differential in any of these things, whether it is textile or it is shrimp or it is diamonds. Diamonds, I think there is no point in, no one is going to pay 50% higher for a diamond, because we only do 5% value addition for the whole diamond price to become 150 rupees from 100 is kind of quite ridiculous. So it is a very serious issue. And we also believe that there will have to be some kind of a support which either RBI or the government will have to give, at least in the short term, because we are worried. We have taken rating actions, but mostly actions are, putting the rating on watch negative or negative outlook, because we also, as a lot of other people, are expecting that once the US trade deal is finally firmed up, these things will not be as bad as it is right now. But if it indeed remains, which is what your question is, I think some of these businesses will become clearly unviable. The other question is very general questions, but let me take one more. One is why euro is appreciating against dollar. I don't think anyone wants to take that. Euro versus dollar. I'm not expert enough to comment on this. Anyone? Or we will just leave it. Okay, then I have another one. Our working population will be active for next 20-25 years, leaving India with next 2 decades of proactive growth. Will that be a challenge or a limitation after 2 decades for India's corporate sector? Would we become like Japan? These are very thought-provoking kind of questions.
So Sachin,
Gopal,
I would actually say something on this, because
please,
some level of data crunching was being done. So while we talk about China versus India, today in terms of investments, China is way above us. When you talk about this, the demographics, okay, India is now falling into that sweet spot where that demographic advantage is going to actually just kickstart now for India and is going to continue. So, the gentleman, whosoever has written, has very rightfully written that we see that happening up to 2048, 49. When again our demographic population starts aging the way things are, China is already, getting into the disadvantage zone by the end of around 2028, 2029. It's just like a few more years. So that clearly is an advantage for us. But, again, like 20 years of good time, and why we should be worried beyond 20 years. Yeah. If in 20 years, because if you really see, China also got built up over 20 years. Whatever growths they have done, one was the intent. So I think today the intent is there from the government side clearly. The reforms have worked in the right direction. The one of our strength is our BFSI, actually, if you really see. Okay, the way qualitatively it has improved. So capital availability would be also be there. This short-term hiccups which we are seeing today because of tariff war and all those things, I'm sure will all get settled down in the next 3 to 6 months.
I think the key thing is to make best use of these next 20 years, not worry about what's going to happen after 20. So that's
absolutely, and 20 years, if India starts doing well, which India will, then who knows, after 20 years, we'll be talking something very, very different. We'll not even be concerned on these points.
Gopal, you had some comments on this one?
No, I think he said that. I would only say one thing. Many times when we are discussing at various forums, this becomes a point of discussion because while we have this demographic dividend, we need to ensure that we are able to, kind of use this dividend and invest it wisely. I think one challenge that we have is the growing presence of AI. And that is not something that we can wish away now, because I think ultimately what the majority of population would require is to stay gainfully employed and ensure that the average wages of the country keep going up. That becomes very, very crucial because even on a global index, we are still much lower.
Yeah,
so while
our wages are not growing, our wages are stagnant. Yeah,
our wages are sagging, and while we are in terms of GDP terms very good, when you look at the average GDP per person still at about 2,500 or 2,800, that is, and I'm not trying to be against the country. I'm a staunch Indian, but I'm just saying that we are at that. So when I look at the weighing scales, the weighing scales have to be told, right? They tell the truth. So that is 2,800. So, we need to have something coming out. One of the things that I possibly believe that we have to get back, which is not available, is a document of some sort of a plan. I'm not suggesting we go back to the 5-year plan, but we need to know exactly what is the capital investment that the government is going to do, what is the employment that the government is going to do, what is it going to invest in education, how are we going to build the technology resilience of this country, how are we going to reduce import dependence, so that industry services are able to plan accordingly. And once we give certainty, even for NBFCs, because I sit on the board of Hinduja Leyland Finance as well. So, I think if we get in a lot of policy certainty to this, then what happens is entrepreneurs and private sector will start investing, betting on certain things, because they're there to make those bets. I think that is very, very crucial, because like the question was posed, 20 years later, what is an asset to us? It can become a huge liability.
Yeah. And we don't even have any social security, so to say. So
and maybe Sachin, I'll just add one. I don't know if you have time, but just a quick minute
we have a few minutes. Yes.
I think what is being spoken about. Yes, it is a very big demographic dividend that we have today, but the fact still remains that like the data on GDP per capita, even on productivity levels, whether we talk about AI, whether we talk about new technologies, unless all of this is boldly adopted and it helps us improve productivity, whether it's workforce, banking, insurance, we will be left behind. There was this very interesting BCG report which says that in the last 10 years, the banking industry's IT spends have gone up by 17% CAGR, but productivity has gone up by 1%. So that just tells us that that we are just not focusing enough on productivity, and unless that happens, then AI, rather than becoming an enabler, is going to become a challenger and further accentuate the problem. So we certainly need to focus on productivity by leveraging these new technologies if we really want to flourish for the next 20 years and create a safety net for the balance.
Great. Thanks, Rakesh. One more question, and this could be our last question. Which sectors have shown the strongest credit performance in H1 FY26, and what are the key drivers behind their stability or growth? Actually, that is really the whole crux of our presentation. This is Rekti Sharma. I will advise, while I can give you a brief answer that the highest growth has been seen in infrastructure sectors, within that roads and renewable energy, and on the corporate side, we have seen a good performance on the hospitality business, real estate, pharma, even metals. But I would as we mentioned that we will be sharing this full detailed presentation with you right after the webinar. So you please go through it, and that will kind of hopefully answer your questions. Okay, I think we have one more question. Rakesh, this also somehow people are more keen on NBFCs. So one more question which says, this is about providing loan for students going outside India for education. So how will this with H1B issue going to impact the NBFCs and banks? Is that a big risk that you see?
So let me start by saying that a few years ago we had learned about the concept called VUCA world, right? And now we live in something that I coin as a TUCA world, which is Trump's created uncertainty, volatility, and ambiguity, right? So unfortunately, yes, a lot is in transition. A lot is going to get impacted because of the geopolitical issues that are currently at play. It's not just the US, unfortunately, even if we look at Canada. And these were two of our largest markets for students going out for education and trying to create employment and a brighter future. Unfortunately, not just H1B comes much later, but overall, the unfortunate reality is that they are making it much harder for Indian students to survive and do well in foreign universities, which will certainly have a direct impact on loans and credit needed to fund these expensive fees. We are really hoping that this is transitionary and better sense will prevail. And because the fact is that a lot of these foreign universities actually depend a lot on Indian students being there, and they actually the local economies are supported purely by a large number of Indian and Asian students, going there. So hopefully this better sense should prevail. Otherwise, yes, taking high expensive loans, large loans, will become challenging because employment opportunities in the US and Canada are not going to be as easily available as they were in the past.
Got it, Rakesh. I completely agree with you. Great. So on that note, we will, bring the session to a close. Let me take this opportunity to thank all of you, Mr. Nikhil Soni, Mr. Rakesh Kaul, Mr. Manoj Tulsian, and Mr. Gopal Mahadevan. It was indeed a pleasure to host you, and your inputs were very valuable. And I hope that our audience also gained valuable insights with our conversations and our presentation. Thank you.
Thank you.
Thank you,
Thank you.
Sachin. Thank you very much.
Thank you. Bye-bye.
Thank you.
Bye.
Thank you.